Hello, everybody, and thank you for joining us for today's webinar, Preparing IRA Beneficiaries to Secure Your Legacy, presented by the Entrust Group. Before we do get started, I do have to read a brief disclaimer. The Entrust Group does not provide any investment advice, nor do we endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. Today's agenda, we will cover the IRA Beneficiary Basics, what all benefactors and beneficiaries must know, avoiding common legacy planning mistakes. We will be providing you through a link in the chat with a bonus beneficiary preparation checklist. And at the end of the presentation, we will have time for questions and answers. My name is Tony Uncle, and I am a business development manager here at the Northeast. I have been with Entrust for 6 years, and I enjoy educating investors and professionals on tax-preferred retirement accounts. About Entrust. The Entrust Group has a little over $5 billion in assets under administration, with 22,000 active accounts, 40 years in service, and we provide our clients with one single point of contact based on your region. We are self-directed IRA administrators. Our staff is knowledgeable, with many holding a CISP designation. We do have nationwide offices. We hold in-person and virtual events. We provide national continuing education program for other credentials, including our biannual IRA Academy. What is a self-directed IRA? Self-directed IRA is simply a retirement account in which the individual investor is in charge of making all investment decisions. They provide greater opportunity for asset diversification outside of traditional stocks, bonds, and mutual funds. All securities and investments are held in a retirement account administered by a regulated custodian or trustee. Beneficiary Basics. Planning for a legacy. Legacy planning is the process of defining how your wealth will be transferred to the next generation. Many pieces to the puzzle. Yourself, your beneficiaries, the inherited IRA, and the IRA custodian. Now let's take a quick poll. See how prepared you are. You? Why naming your beneficiaries matters. Naming beneficiary aligns your investing legacy with your financial plans. It creates structure for handling the inheritance of your assets. And it better prepares your beneficiaries to help you realize your goals. Not naming beneficiaries names your estate as the sole beneficiary by default. It might make your IRA or retirement account subject to a will. It could cause your assets to enter probate and expose your wealth to fees and taxes. To prepare your beneficiaries, you must understand the flow of funds for each contingency, from the IRA holder to the beneficiaries to successor beneficiaries. What you must know as beneficiary. Education is always the best preparation. It demystifies the complexities of inherited IRAs, provides structure for managing an IRA, and it gives the beneficiaries a head start. Very important to keep your beneficiary forms updated. Should be done annually. You will update contact information, date of birth, tax IDs or social security numbers, and the relationship of the beneficiary. You had many options for beneficiaries prior to the signing of the Secure Act. For example, the 5-year rule. Beneficiaries must distribute an entire account within 5 years. Possible if the benefactor did not start taking RMDs yet. Failure to comply with this rule is penalized. Number 2 is life expectancy payments. Beneficiaries can deplete their inherited account incrementally. Life expectancy payments are calculated using the IRS Form 590B. Failure to comply with this rule is also penalized. Some rules after the signing of the Security Act. There are eligible designated beneficiaries such as a spouse, minor, non-spouse beneficiary that is less than 10 years younger, a beneficiary who's chronically ill or disabled. Designated beneficiaries are non-spouse beneficiary more than 10 years younger, and your non-designated beneficiaries are charities and your estate. Eligible designated beneficiaries can deplete the account with life expectancy payments. Designated beneficiaries must deplete the inherited IRA within 10 years, and non-designated beneficiaries, if the IRA holder died prior to starting RMDs, must deplete the inherited IRA within 5 years. If the IRA holder died after starting RMDs, life expectancy payments using the deceased IRA holder's age. There's a special rule for spousal beneficiaries. Special beneficiaries can keep the assets in the original account, now renamed as an inherited account, or they can move the assets to their own IRA. How do you handle multiple beneficiaries? Your oldest beneficiary's life expectancy is used for everyone. Exception, when inherited accounts are separately accounted for by the end of the year following the year of the death. If you name a trust as a beneficiary, the trust must be valid under state law, have identifiable beneficiaries, be irrevocable upon death of the trustor. Renaming accounts for tax reporting purposes. Proper titling of the account and on the IRS Form 1099-R. The account name should include the name of the deceased owner and a clear indication that the new individual is a beneficiary. Some examples below: John Doe, deceased, for the benefit of Jane Doe, or Jane Doe, beneficiary, FBO, of John Doe. What have we learned so far? Give you a couple seconds to answer that. The ex-spouse gets the IRA. IRAs pass by the beneficiary form, not the will. Very important, continually update your forms immediately. Anytime there's a life event or on an annual basis, remember to go in and update your beneficiaries. You can teach the rules, investment restrictions. So the same rules would follow. You, with a self-directed IRA, cannot invest in life insurance, collectibles, or S corporations. Prohibited transactions is any improper use of your IRA by you, your beneficiary, or any disqualified person under IRS Publication 590. There's no self-dealing allowed. You must be an arm's length transaction. Prohibited transactions can be direct or indirect. And below we have listed some acceptable transactions. Disqualified persons to an IRA, the rules to follow. A disqualified person to your IRA is yourself, your spouse, your lineal descendants, and all their spouses, any beneficiary of your IRA, your trustee, custodian, or anyone providing a service to the IRA, any corporation, partnership, or estate that you or any disqualified person have at least a 50% stake in. All of these individuals are prohibited from doing business with your IRA, and your IRA is prohibited from doing business with them. Required minimum distribution deadline essentials. when your spouse is the sole primary beneficiary. The first distribution is due by the later of December 31st of the year after the owner's death, or the year that the owner would have reached required distribution age, which is currently 73. A non-spouse or a spouse that is not the sole primary beneficiary, distributions begin December 31st of the year after the owner's death. Remember the fees. When there's an inherited IRA, you want to maintain the tax-deferred status of that IRA. The record-keeping fees must be paid to the custodian in a timely manner. Avoiding planning mistakes. Do not make legacy planning mistakes. Remember, inherited funds cannot be rolled over. Update your beneficiaries when named. Remind them to seek professional help for guidance to avoid unintended penalties and costs. Prepare them to manage required minimum distributions, even for Roth accounts, and proper tax reporting. One more poll. As a bonus, we provided you with a preparation checklist. This checklist will be available via a link in the chat below. Thank you for joining us, and we'll cover what's next. Our upcoming webinar, 2024 IRA Essentials, Changes and Deadlines All Holders Should Know. Register today and join us on January the 17th. If you would like to learn something new, please let us know in the survey as you leave. For more information on self-directed IRAs, visit our website, theentrustgroup.com, and visit our Learning Center. And please follow us on all social media platforms for timely updates. At this time, we'll happily open it up for some questions. You can type your question in the chat box.
Thank you, Tony. And for anyone who did, for the last poll, still need help understanding anything, please enter that question in and Tony will do his best to help you out. Seeing a question about emailing slides. Yes, for everyone on the webinar, we will be sending a full replay along with the audio files and presentation slides for all registrants. Thank you.
I have a question. Can you leave over 18-year-old children your IRA? Yes, absolutely. Keep it open for a couple of more minutes. If you have questions, please do type them into the question box. If you think of a question in the future, feel free to reach out to me directly. We do have a couple of popping in. The webinar will be available in our Learning Center under Webinars and Events. You can absolutely email additional questions after this. Please find my contact information on the screen. All right, after someone passes, does Entrust notify the beneficiaries, or does the beneficiaries contact Entrust? A little bit of both. We would need to be notified, obviously, of the passing, and typically we are notified of one of our account holders' passings by a beneficiary. Once we are notified, we do work with the beneficiary to open the inherited IRA and assist them in rolling over or transferring the assets to the inherited IRA. Okay, thank you very much, everybody. If there are any further questions, feel free to reach out to me.
Tony, can you see those three?
Again, oh, sorry, yep, oh, I did see them. How long can an estate be left open to dissolve assets? It all depends on the age of the individual that had passed away, as there are certain rules applied to certain individuals, but you do have to follow the normal distribution table. So it could be anywhere from 5 to 10 years. What is meant when an inherited IRA cannot be transferred? It's only for spouses that you can move it to your existing IRA. If you are a non-spouse, you will have an inherited name and inherited IRA in the name of the deceased IRA. That was that John Doe deceased for benefit of Jane Doe. My will provides for a testamentary trust to be created upon my death. Are there special considerations with that? For that answer, I would suggest that you speak with an attorney or a CPA for anything regarding the family trusts. You know, we got one more that came in. My IRA beneficiary is a trust and my sons are the trustees. What are the tax consequences if they cash out or can get monthly payments? So anything tax related, you should always speak to your CPA. Your children that inherited your IRA will have to follow your required minimum distribution age. And if you are up for RMDs, then they will have to start taking those RMDs and those will be taxed accordingly. What are the rules for a disabled beneficiary? We'll have to get back to you on that one. And then is it 7 years or 10 years, your beneficiary has to take funds out? Again, it all depends on the age and the circumstances around the account holder. Well, thank you everybody for joining. Anything additional, feel free to email us. Give me a call or email me at the contact above. And we always like to leave every webinar with a nice quote: an investment in knowledge pays the best interest. Benjamin Franklin. Thank you very much, everybody. Have a nice day.